what other mechanics do you use that help kind of sweeten the pot? Like, how can we create more income amplifiers than what we've just discussed? And by the way, what we've just discussed are great. I mean, if you got just one of those, it could be incredible. But often you guys are getting many of these. And in the deals that I do, I'll often get these layered on top of one another. So is there anything else that we should pay attention to?
Yeah, it all depends whenever you're pricing a deal. A big part of it, and this is, and again, I think we spoke about this, Justin, on a lot of our calls, is, psychology is a big factor in investing, lending, in pricing. And so, knowing how your customer, could be your borrower, could be the company you're buying, how they think and how they operate. And so one example, that we think at is that sometimes the only thing that matters to the borrower is the interest rate. They don't care about the closing fee or the OID, which is called original issue discount. They don't really care so much about the other fees because they're fixated on interest rate. And so in that case, you're able to have a lower interest rate but have higher fees that ultimately get to you to a better spot from a return perspective.
That's awesome. And those are kind of like the focuses on upside, on income amplifiers, how to enhance the overall return. Let's take the other side of the coin here and talk about, how do you de-risk a deal? I mean, one of the ways, most certainly, is collateral. You would collateralize your loan or an investment. You could collateralize for a lot greater than the value of the loan or investment. I think that is, a real interesting way of doing it. There are other mechanics that you can put into place, but I'd love to hear some of your thoughts on how you do it, because this is really where you are the master, right? An underwriter, an analyst, this is your sweet spot.
Yeah. And that, we spoke about being senior, right? Senior meaning you are the first to get paid in the capital structure. The next piece that goes along with that is secured. So senior secured lending, that's what we do. That means that not only are you first, but you have a security interest or a position on specific collateral. That could be real estate, that could be equipment, that could be accounts receivable, it could be intellectual property, or it could be the stock of the business. All of these are forms of collateral that further improve your position. Like your bank, that is your mortgage provider, they are lending you money based on the value of your house. And therefore, they lend you 60 or 70%. And they feel at no point, or at very, very low percentage chance that they'll ever lose money, because it's backed by the collateral. And so number one is just being secured, and being secured at a very low, what we call loan to value. So lending 20, 30, 50% against that collateral value really gets you in a good spot. Beyond that, there are other ways to improve your position. It could be having a personal guarantee from the owner. That, I would say, it's more so in place for a cooperation guarantee than an actual access to secondary capital, but it's good to have their attention and cooperation if anything ever was to go wrong. Beyond that, it's really what I like to call structuring the covenants in place, so that if anything happens from a financial perspective, or anything changes, that you have an ability to effectuate change before there's real deterioration in value in your borrower.